We will walk through the key VAT rules that foreign companies need to understand before doing business in Denmark, so you can operate confidently, stay compliant, and avoid unexpected tax exposures. Denmark is part of the EU single market, and its VAT system follows EU directives, but there are important national specifics that matter in practice. Whether you are selling goods into Denmark, providing digital services, or planning to establish a local presence, having a clear grasp of when and how Danish VAT applies is critical to managing both cost and risk. Let's start with the fundamentals. VAT in Denmark is a consumption tax, generally charged at a standard rate of 25%, with very limited reduced rates or exemptions compared with many other EU countries. For most foreign businesses, the key question is not whether VAT exists, but whether your activities trigger an obligation to register, charge, and report Danish VAT. In broad terms, foreign companies must consider Danish VAT if they are supplying goods or services where Denmark is considered the place of supply under EU VAT rules. Determining the place of supply depends on the nature of the transaction. For goods, it often hinges on where transport starts and ends. For services, it depends on whether the customer is a business or a consumer, the type of service, and where the customer is established. If you are a foreign company selling goods to Danish business customers under standard B2B arrangements, in many cases the reverse charge mechanism will apply, meaning that your Danish customer accounts for the VAT in Denmark, and you may not need a local VAT registration, provided specific conditions are met. However, if you hold stock in Denmark, operate a consignment warehouse, or make local supplies where you are responsible for delivery within Denmark, those activities can create a Danish VAT registration obligation because you are effectively making domestic supplies. For foreign companies selling goods to Danish consumers, especially via e-commerce, the rules are more nuanced. Since the EU introduced the One-Stop Shop, OSS, and Import One-Stop Shop, IOSS regimes, cross-border B2C sales of goods and digital services can often be reported in a single EU member state. But you still need to understand when Danish VAT is due and at what point distance selling thresholds or platform rules become relevant. If you are not established in the EU at all, you should assess whether you need a Danish VAT registration directly or whether an intermediary or electronic interface, such as a marketplace, is deemed to be the supplier for VAT purposes. For services, many B2B transactions fall under a general rule. Services supplied to a business customer are taxed where that customer is established, with the customer applying reverse charge. In such cases, a foreign supplier may not need to register for VAT in Denmark, but still has to ensure that invoices are correctly drafted, indicating that reverse charge applies and not charging Danish VAT incorrectly. Exceptions to this general rule exist, particularly for services related to real estate located in Denmark, certain event admission services, and short-term hiring of means of transport, where Denmark may become the place of supply, triggering Danish VAT and potentially a registration obligation for the foreign supplier. For B2C services, such as telecommunications, broadcasting, and electronic services supplied to Danish consumers, the place of supply is generally where the consumer is located. Foreign companies providing these services to Danish end users must ensure that Danish VAT is correctly applied and reported, typically through the EU's OSS scheme if they are EU established, or through a non-union OSS scheme if they are established outside the EU. Once you determine that a Danish VAT registration is required, the next step is to understand the registration process and ongoing compliance obligations. Foreign businesses normally register with the Danish Business Authority and obtain a CVR number, which also serves as the VAT registration number. Non-EU entities may need to appoint a fiscal representative, depending on their activities and risk profile, although Denmark has, in some cases, relaxed strict representative requirements, making it important to confirm the current rules before proceeding. After registration, you are expected to charge Danish VAT where applicable, issue invoices that comply with Danish and EU invoicing standards, and file periodic VAT returns, typically monthly or quarterly, depending on your turnover. Timely and accurate reporting is essential. Late filings or underpayments can result in penalties, interest, and increased scrutiny from the Danish tax authorities. Another critical aspect is the right to deduct input VAT. If your Danish VAT-registered activities involve making taxable supplies, you can usually deduct the VAT incurred on business-related purchases in Denmark, subject to normal rules and limitations. For example, on certain types of entertainment or passenger cars, input VAT must be supported by proper invoices and recorded correctly in your VAT accounts. Non-registered foreign businesses that incur Danish VAT, for example on travel or event expenses, may in some cases reclaim that VAT via the EU refund procedure or the 13th directive mechanism for non-EU businesses, provided strict documentation and deadline requirements are met. Transfer pricing and intercompany transactions can add another layer of complexity. If you are operating through a Danish branch or subsidiary, you need to consider how management services, cost allocations, and shared functions are treated for VAT purposes. While some intra-group transactions may be disregarded where a VAT group is in place, Denmark has specific conditions for VAT grouping that must be met, and not all foreign entities can join a Danish VAT group. In addition, you should be aware that customs and VAT intersect when importing goods into Denmark from outside the EU. The importation triggers import VAT, usually payable at the border, which can be deductible if you are VAT registered and the goods are used for taxable activities. Structuring your supply chain to manage where imports occur, how goods move within the EU, and who acts as importer of record can significantly impact cash flow, administrative effort, and overall VAT risk. From a governance perspective, leading companies operating in Denmark invest in clear internal policies, robust ERP configurations, and periodic reviews of their VAT footprint, especially when launching new products, entering new customer segments, or using online platforms. Danish tax authorities leverage data and analytics to identify anomalies, so inconsistencies between customs data, VAT returns, and financial statements can trigger audits. Proactive preparation, including maintaining documentation on the nature of your supplies, contracts, and VAT position, helps reduce the likelihood and impact of disputes. To summarize, understanding VAT rules for foreign companies in Denmark means working through a structured set of questions. Are you supplying goods, services, or both, and to businesses or consumers? Where is the place of supply under EU and Danish rules? Does the reverse charge apply, or must you register and charge Danish VAT? How will you handle invoicing, reporting, and input VAT recovery? And finally, do your systems, contracts, and processes support compliant and efficient execution of these rules? If you are planning or expanding your activities in Denmark, it is advisable to conduct a focused VAT impact assessment, confirm your registration obligations, and align your compliance framework accordingly. By doing so, you can participate fully in the Danish market, capture growth opportunities, and maintain the level of tax governance expected in a mature and transparent jurisdiction like Denmark.